So first of all, folks, I want to remind you about what an employee stock option is. So we did sort of charge ahead here, and so you probably, your head may be swimming a little bit. An option is just a right to purchase a certain number of shares of stock at a certain price for a certain period of time. That price, by the way, is usually the fair market value on the date that the option is granted. This is an agreement between the employee and the employer, and as John said, it usually goes for a 10-year period of time.
Maximum.
That's the maximum, particularly related to employee stock options, by the way. Incentive stock options, qualified stock options. Now, there is a thing, a lot of people say, well, options, wait a minute, isn't that high risk? Isn't that gambling when you're getting involved in these option exchanges? Well, options do represent, as I see it, sort of the risk element when you're doing this. But when you're using it with an offsetting position here, you can also look at an option as a form of insurance.
Right. I look at it as a form of risk reduction.
Okay.
Okay.
But this is because this is the offsetting position, though.
Right.
So that's the
see,
key here.
If you own those employee stock options, there's a lot of similarities between those things and the exchange traded options.
Yes.
Even though you generally have longer lives here, you have restrictions on them with the employee stock options. The listed exchange traded options, you can buy them today and sell them that evening if you want. But there are similarities, okay? And the similarities are they're on the common stock of the company.
Right.
They give you the right to buy the stock at a specific price throughout a specific period of time. You can use those to reduce the risk that's inherent in holding the employee stock options by selling the calls, because they have similarities between themselves and the listed, the exchange traded options have similarities with the employee stock options.
So John, why don't you explain a little bit about what does it mean when you're selling a call? What is a call, and what does it mean when you're selling it?
All right. A call is a particular type of exchange traded option. Mm-hmm. The ones we traded are puts and calls. Mm-hmm. Okay. Call is a contract that you have with the Options Clearing Corporation. The mm-hmm. employee stock options are contracts with the company.
Right.
You don't have a contract with the other guy who takes the opposite position of you, because there's a middleman. It's called the Options Clearing Corporation. That gives you a guarantee that the other side's going to perform. It's actually the middleman, the Options Clearing Corporation, is going to perform. Anyway, a call, if you buy it, you have to pay for it.
Yes.
Employee stock options, they're granted. And people say, oh, I got them for free. How can they be risky? Well, you're really paying for it in the fact that you didn't get paid cash for the value that you got in those employee stock options. And you might have been able to get cash if you would have negotiated and you didn't like those options. Okay.
So let me sort of try to clarify here. Actually, the call option itself, when you buy that call, you're getting a right very similar to the employee stock option itself.
Exactly.
You're getting the right to buy that stock for a certain period of time at a certain price. The option holder who's selling it, basically what he's saying is, I can sell the stock that I get from buying my option or exercising my option to you at that price. Meanwhile, I'm getting a premium. I'm getting an amount that you're paying for that right, for this period of time.
If you hold these employee stock options, you can make a sale, which is an opening transaction in these calls,
yes,
which has similarities to whereby if you actually sold the employee stock options.
Yeah.
Okay? Because one offsets the other.
Yes.
And although it's not a perfect offset,
yes,
because the calls, the exchange traded calls that you're selling have shorter lives, mm-hmm. and they're worth a little bit more because there are no restrictions on them.
Right.
But you can, in fact, effectively use the sale of those calls to reduce the risk of holding these highly speculative employee stock options, because they can go way, if the stock goes way up, you can make a few $100,000 or a millionaire.
Yeah.
Okay. of course, it may go up, you get a couple of $100,000 value, and then next year it's back where it started from, and you
Yes.
have a lot less.
Right.
And whereas you can, in fact, take some profits or reduce the risk that it will go back down by using these listed calls, or in some cases buying puts, which give you the right to sell the stock.
Yes.
Okay, and sometimes in combinations. Now, of course, I used to be a market maker, trading options on the Chicago Board Options Exchange, and I did this every day.
Yes.
I traded 3,000 contracts a day for 10 years.
Yeah.
And in 100 contracts, 100 trades a day.
Yes.
So it's all like second nature to me.
Yes.
But you don't have to be as efficient as a market maker to do extremely fast trades to pull this off.
Yeah.
You can just apply the principles. You sell long-term calls,
Yes.
and you don't want to forget about it, but
Yeah.
you don't have to worry about it
Yeah.
unless a lot of time passes or you get some extreme moves on the stock, therefore changing the theoretical and real value of your employee stock options. But you have an opportunity to reduce risk, enhance the value, and delay the taxes.
Yes.
Okay, so that's what I say to do, rather than make that premature exercise where you giving up some of the value and you're incurring an earlier tax.
Okay.
Okay.
Let's talk for a moment about a few restrictions related to this, like when you can't do it as it relates to employee stock options.
Okay, good. The company can put it in their stock and options plan that you can't hedge it, and therefore you can't do it. However, that doesn't prohibit you from selling calls or even shorting the stock or buying puts on your competitor,
Yeah,
or a
similar
basket,
stock.
or a
Yeah.
basket which you expect to move similar to how your stock is going to move.
Right.
Now, you're never going to get 100% positive correlation, but sometimes if you sell the weaker ones and they go down and you'll stay up, you make more money, and you can make money on your employee stock options going
Yeah.
up.
Yeah.
Okay, and some people actually suggest, and I'm not taking it too seriously, but some people suggest that the executives from J.P. Morgan and Goldman Sachs shorted Bear Stearns.
Oh my gosh.
Okay, all right. Also, some of there are you have to place the margin up to make these shorts of calls or
Yes.
buy the puts.
So you have to put some
You have
money
to put up
up.
some money.
Or,
Now-
or some security.
or some securities. You could put up, a lot of times people have stock in the options, and you could just put the stock in the account, or in some cases you might have some options that are way in the money and they're getting ready to expire. You can exercise those prematurely, and or slightly premature, and take the cash and advance that for the margin.
Yeah.
Now, if you're an executive, that is, if you're an officer and director,
Well, let's say an insider, is that what
yeah, that's
we're
what it
gonna
is.
do? Okay,
The
so
officers, directors, and owners of 10%,
Okay.
they are subject to certain SEC rules,
yes.
which restrict them somewhat.
Yes.
However, you can get, if you sell out of the money calls against substantially in the money employee stock options that are vested, you can do that as a hedging strategy.
Yeah.
And that gets a little complicated. It's also a little complicated as to what the taxes are on the gains and losses on the sales of these options to
Right.
hedge against your employee stock options.
Okay. So
And
we're
that's
not
really
gonna-
beyond the scope
Yeah,
of what we're going
yeah,
to get
that's
into. That's
going-
for the next tape.
Okay. Well, maybe another show some other time. All right. So anyway, also there's the issue, of course, there are some companies, some people get options in employers that are not publicly traded. Obviously, these people can't get a traded option related to those companies.
They can't.
Yeah,
But
yeah.
if they really wanted to, they might be able to
Find
somebody to take the
something
other side.
similar or something.
Although the book, and I really don't want to get into that, because you have no publicly traded options and no publicly traded stock. You're going to have to make a big concession to the other party, and
Yeah.
you're going to be in it for a long time.
Yeah. Okay. So really what we're talking about, what we're trying to